So myself and Kelly McAdam, who is the co-author of this particular presentation, are conducting these kind of sessions across both New Hampshire and Maine. And we're working with Chris and with Tori Jackson from the University of Maine to give folks an opportunity to understand a little bit more about what's happening with farm taxes, especially if you're a beginning or new farmer. And that's one of the purposes of these grant funds, is to introduce folks more to some of the concepts associated with farm income tax returns on a federal level, and see if we can't get you some resources that you might be able to use in preparing your returns. Now, if you have trouble hearing me or any of those issues, let Chris know. I'm going to watch my presentation, and as you go through, I hope Chris will collect the questions, and we might, if we have time, we'll stop at a couple different points and we'll answer the questions. If I have a difficult time answering the questions or need to do a further research, I'll get back to you if you just want to email me. And I'll give you my email address at the end of this presentation. So let's get started. I hope. Okay. Yeah, oops. Yeah, it's always good. Let's get, there you go. That's it. We're all done. No, I'm sorry. I know. I just have to tell you, this is a program that's supported by USDA funding, and that USDA is not responsible for the content, but the authors are. So if you have issues with the content, give me a call. Okay, come on now. I'm getting, my screen's being sentimental for some reason. I'm not sure why here. Come on, there we go. Let's give you a little bit of an outline of what we're going to cover today. We're going to talk a little bit about how USDA and IRS defines a farm and a farmer. We're going to talk a little bit about filing the Schedule F, which is the primary tax return that farms file, whether they're full-time or part-time farmers. We're going to briefly talk about some of the other forms used by farmers to prepare their taxes. We'll discuss a little on farm records and tax preparations, and I'll give you some additional sources of information. Good, got it working. Okay, so briefly, what is farming? I don't think this is anything you guys don't know, but just this is sort of the definition that IRS uses. I've kind of modified it so it sounds a little bit like English, but you're kind of planting, growing, and harvesting crops, or breeding, raising, and producing livestock products. The important part of this particular slide is that some of the production activities can also include additional handling, processing, if you will. So they allow you to do like things like on-farm drying and washing, packing, grading, and storing of a commodity or product in its unmanufactured or natural state. And the key here is that that stuff's incidental to the growing and producing of the commodity.
I got it.
So that's important, okay? When you take a look at that definition. We'll talk about it more in a minute. So what's a farm? Again, this is probably not anything new to you, but a farm is basically, you know, where those activities where you're encompass livestock production. We might have dairy, poultry, fish, fruit, or truck operations, and they include nurseries, orchard, ranches, and greenhouse operations. So there's a pretty broad definition, generic definition of what a farm is. Who's a farmer? The important part of this particular definition is that a farmer operates a business for profit, okay? And if you're not operating a business for profit, you would be considered a hobby operation or a hobby activity. What's the difference between an operation that's conducted for profit and an operation that's run as a hobby? Well, with a hobby, you're very limited in the expenses you can deduct against hobby income, and hobby income cannot exceed the cost of goods that you have associated with that particular activity. So you can't have a loss which is used to offset other types of income on your tax return. If you are for profit, basically you're running the farm as a business. You carry on as a typical business would. You maintain records. You spend considerable amount of time in the activity. you hope that the business will increase in value and eventually generate a profit. You know, those are the kind of things you're looking for. And if you do not generate a profit, have a loss, that loss can be used to offset other sources of income. Okay. All right, so farming is not agritourism, according to IRS, nor is it landscape maintenance or design. Farming is not processing commodities into value-added products, whether they be wine, pickles, cheese, that kind of stuff. If you're in the business of trucking farm products to a market as a service business, that's not farming. Custom spraying, pruning, and harvesting as a service business is not farming. So there's a number of things that are not farming.
Mike?
Yes.
There's a question, is honey production included within the farming definition?
Yes, honey, and I'll get to that, but honey is one of the exceptions that you can actually keep the bees, because bees are considered livestock, and processing the, what do you call it when you collect from the bees? I guess it's honey. Processing the hives and producing honey is actually part of a farm operation. However, if you look at maple syrup, actually they define the collection of the sap as farming and the processing of the sap into syrup as non-farming.
What?
Yeah, that's typically what they do. So that's something you'll have to, boiling and bottling of sap is not considered farming by IRS.
Did you hear that?
Okay. Now, there's some situations where if it's a small part of a bigger operation, that kind of stuff is usually overlooked, and I'm going to talk about that in a moment. Okay, so if you're a farm, you report your income and expenses on what's referred to as a Schedule F, profit and loss from farming. If you're a non-farm business, you report your business expenses and income on a Schedule C, profit or loss from business. These are all pretty standard. These are the two standard forms for self-employed individuals. Now, farms do have some special sort of criteria or conditions, if you will, that apply to them that don't apply to a Schedule C business. They can deduct certain kinds of conservation expenses, which Schedule Cs can't. They have some special rules with regards to how you deduct a vehicle used in your operation and some of the benefits you might have as a result of farming. But they also have another special rule that's called full-time farmer for filing IRS estimated tax purposes. And what that says is you're basically a full-time farmer. If 2/3 of your gross income comes from farming, then you don't have to worry about filing an estimated tax on a quarterly basis. Okay? That doesn't mean that you have to have 2/3 of your gross income from farming to file a Schedule F. Part-time and small producers still use a Schedule F. They just have to be aware that if they're generating a profit in there, they might have to pay some additional estimated taxes so that they're not penalized at the end of the year if they underpay their taxes significantly. Okay? Okay. Farm versus non-farm, a few quick examples. In this first example, we have Anna and a daughter growing fruits and vegetables for sale through their farm stand, obviously an agricultural business. They also purchased a small amount of apples and cider from another grower for resale at their operation. Probably it's going to be listed on their Schedule F as other income. And since it's not a significant part of their overall farm sales, it's not going to be an issue with regards to whether they're reporting it on a Schedule C or a Schedule F. Number two, Dominic has high tunnels, which he uses to produce garlic and herbs for sale at the farmer's market. That's a farming activity. The expenses and receipts associated with that activity will go on a Schedule F, even though he's not a farmer as far as classification for estimated taxes, because he has a full-time job at a software company, and that's probably his principal occupation where he earns most of his money. In the third one, Sarah has an apple orchard and a pumpkin patch, and she sells apples and pumpkins. agriculture, but also produces pies and cider. Technically, the pies and cider are Schedule C income. And so they have to report it on the Schedule C. However, if they're not significant, if they're only part of the farm income, and significant is sort of one of those gray areas, you know, if you get up above half of your farm income and it's in pies and cider, well, it's probably good to have that stuff on a Schedule C. If it's 25, 30% or some small amount, you probably can put the apples and cider on your Schedule F and include all the costs associated with producing those pies and cider on your Schedule F. So there's a little bit of a gray area here. And so you have to be careful how you do this and make sure that it's not a significant amount. In the last one, Jamal has 5 acres of pick your own high bush blueberries. He also uses a farm equipment for digging holes and trenches for various contractors. Again, this is the same issue as number 3, but a little bit different because now he's actually producing, actually using his equipment for digging holes and trenches for other people. As long as that's not a significant part of an income, that can go on a Schedule F and record it as custom hire income. If that digging holes and trenches is a big income, that income needs to go on a Schedule C, and the income and expenses from producing the high bush blueberries need to go on a Schedule F. Okay, so it's all a little bit of a judgment, if you will. Who are the principal? Yes.
A couple more questions.
Sure.
Steve is asking, are maple syrup sales farm income? If not, is there farm income from producing the sap if I use it for my own syrup production?
Yeah, so what you would do is if you use it, so remember, what we're saying is that I guess you only really do sell. If you're only producing maple syrup, then up to the sap is considered farm production. So you would sell the sap to the Schedule C, and the Schedule C would do the processing and sell the syrup, technically. Is that the way it's always done? I can't tell you for sure, because I know on many small operations where sap is part of their operation, or maple syrup is part of their business, it's usually commingled in with the farm income and expenses. But if you're only producing maple syrup, and that's where all your income is coming from, that activity, then you would probably have to separate out the sap collection and the processing of the sap into syrup as Schedule C.
And there's another question about what if you are selling eggs?
You mean buying them and reselling them, or do you mean just if you're producing eggs and selling them? That's fine. If you grow eggs, I mean, if you have pullets and you produce eggs and you sell them, not an issue. That would be considered minimal amount of handling, and part of the way in which you sell an egg. You don't sell individual. I mean, you sell them in a carton or in a crate or whatever, because I don't sell them in. If you're buying in and reselling eggs, what do you think the answer is to that question, Chris? Is it significant? Is it your principal occupation? If it is, and you don't have the chickens, and you're not feeding the chickens, but buying them from somebody else and reselling them, and that's all you're doing, that's a Schedule C business. Okay, so again, this is a gray area, so you got to be careful with it. You need to have someone who understands what those gray areas are and understands the risk they're taking, and you need to be comfortable with that risk if someone comes in and redefines it. Okay, two of the principal resources that we use in agricultural taxes is the Farmer's Tax Guide and the instructions for Schedule F. Both of these are available to you on irs.gov. If you look at the publications, the Farmer's Tax Guide is, in fact, 40-something pages long, and it is a really good resource guide for anybody who's interested in learning more about farm income tax preparation. The Schedule F is the profit and loss from farming, and this is the front page of the Schedule F, and you'll notice on the front page of the Schedule F, it really has 3 sections. The top section up above here is refers to the information block. Part 1 here is where we report farm income, if we're reporting on the cash method, and we'll talk about that in a moment. Part 2 here is where we report expenses, and you report expenses there regardless of whether you use the cash or accrual method of accounting. And then the net profit is calculated down here on line 34. On the back of the page, there's information for inventories of crops and livestock products and other types of things to convert cash income to accrual. So if you decide to use the accrual method of accounting, then you'll have to fill out Part 3. Part 4 is just a list of agricultural activity codes, which you have to look at once. Basically, it's where you enter the code up here in B on the information block. Okay, so let's quickly look at each of these sections. In this example, I'll give to Chris so you can look at it a little bit closer if you want. So you put your name, you put your social security number, you identify what your principal crop or activity is in A, and that's something you're identifying. So it's what you feel comfortable with describing your products. The code, however, is something that comes from the back of the Schedule F, and there's a list of codes, and you choose the best one that fits your farm. Part C here is pretty important because when you first file your tax return, you have to decide how you're going to file it and how you're going to report receipts and expenses. You have a choice of reporting receipts and expenses either on an accrual basis or a cash basis. 99% of farmers choose the cash basis, all right? And what that means is that you agree that you're going to report your receipts when you get them and your expenses when you pay them, okay? So that means if you had some leftover crop from last year that you didn't sell in 2022 but sold in 2023, you don't have to worry about adjusting the receipts by the inventory you have on hand. You're just going to report what you actually sold and received money for in 2022. Also means that if you bought some fertilizer in December because it was a good idea, because you got a good price, or seed in December of 2022, because you're on the cash method, that expense would be recorded in the year you paid it. So it would be reported in 2022, even though you're not going to use that seed or fertilizer until 2023. So take some time to think about what accounting method you're going to use. Once you place it up there and make that check, you cannot change that method without the approval of IRS. D is the employer ID number. If you have a multi-owner type business, a partnership, or a multi-member LLC, or if you hire employees, you'll need to get an employer ID number, an EIN. And that's fairly easy to get. You can either do it online or you can actually file a Form SS4. And the information on how you do that is on the IRS site. Materially participate question. Most people who are involved with farming are spending a significant amount of time in the activity and basically, are doing it because they want to earn a profit. And so you would check yes on that. On F, the making payments required filing a Form 1099. So there's a rule that if you pay an unincorporated person $600 or more, and that person provides services to you or to the farm, not your personal activity, but to the farm business, then you're required to file a Form 1099 and report that payment to the IRS as well as to the individual by the end of January the following year. If you don't make that payment or you don't file that 1099, there's penalties associated with not filing it. And then the last question is if you were required, did you actually, in fact, file the 1099? And of course, I did file it because I was required to file it to someone that, helped me prune my bushes, to another person. Now remember, it's to an individual and to someone who's not incorporated and not to a government agency and not to a nonprofit. So I talk a little bit more about those at the end of this, but keep that in mind. Okay, let's take a look at income. Schedule F, income, part 1. Now, the first thing if you're looking at this for the first time, you'll notice that there's a lot of lines there that probably don't even apply to you or sound like a lot of extra words for no reason at all. And I'm going to say you're right, because there are a limited number of lines here for reporting farm income, and you're probably only going to have information on 3 or 4 lines for the most part. Remember that when you're reporting under the cash method, that you're reporting income when received, okay? And, okay, that's it. And really we're looking at basically 9 lines here, 8 of which have some descriptions. Let's take a look at each one of those a little bit closer. Let's take a look at line 2 first. Line 2 is the sales of livestock, produce, grains, and other products you raise. Report that income from the sale of farm products when received. This is going to be where most of your farm sales are reported, line 2. IRS doesn't care whether you produced 2 bushels or 2,000 bushels, whether you sold a dozen eggs or 10,000 dozen eggs. What they care about is the money you received. And so what you have is you have a set of records which have all this nice information by enterprise or by markets, and now you're compressing it all into one number that you're going to show the IRS for farm product sales in line 2. Okay. Line 1, a lot of people ignore, and you really shouldn't, because this is really designed for people who buy items associated with their farm production and then resell them later. So let me give you an example. If you have pre-finished plants and you buy small plants and you grow them in their pots for a period of 2 or 3 months, and then you sell them, actually, technically, those plants are items purchased for resale. Now, it's not a plug and it's not a starter plant. It's like you have geraniums and you grow them for a little bit and then you sell them. Those are technically items purchased for resale. The same thing applies to livestock. So you have a feeder livestock that you buy and you finish them out, and basically those are items purchased for resale. And under the rules that IRS has, anything you purchase for resale, you basically account for that cost in the year that you resell it. So you report the sales amount on A, you report the cost of that item purchased for resale on B, and you calculate out a net income associated with that resale item. The other ones that we commonly find, so a lot of the stuff usually occurs, the sale and purchase does occur typically in the same year, so there's no big deal. There may be some other things that you're purchasing and selling, though, however, that is related to agriculture that go over years. And so that might be, you bought some extra fertilizer, which you're actually going to sell to your customers next year. But you bought that last year. You bought some for you and you have a little bit extra. You're going to sell to customers or other farmers. Same thing with seeds or any kinds of gardening tools or things of that nature. Those are basically items purchased for resale, and you've got to kind of keep track of that stuff differently than you do other items that you sell farming. Is there any questions about 1 and 2?
Yeah, there's one question. Rose is asking, would meat birds go on line 1?
Meat birds. Poultry. No, I don't think so, because poultry would basically be, I think it's an agricultural product. Would meat birds go? Because you're buying the small chicks and you're raising them to sell. No, I would think the chicks would be an expense and the birds would be produced as sales of livestock. Any other questions? No.
That's it from the chat.
Okay. On line 4, you're going to report agricultural program payments. So you're going to, if you participate in any agricultural programs through Farm Service Agency or NRCS, Natural Resource Conservation Service, and you receive money to put up, for instance, a high tunnel or for disaster payments of that nature, and you receive a 1099-G to help you build that tunnel or for the disaster payments, essentially you're going to report that income on line 4. And you're going to report the full amount. There's very few situations in which you don't report the full amount on line 4. On line 7, there's custom hire. So when Jamal was doing that little bit of digging for somebody else, it wasn't a big part of his operation. This is where he'd put his custom hire income. If you mow somebody else's field for them and you get a little bit of income from it, this is where you put your custom hire income. Line 8 is sort of a catch-all for other sorts of miscellaneous income. So it can be income derived from breeding fees or from renting farm machinery, if it's a minor part. Incidental income from cider or maple syrup, again, firewood sales. Incidental, meaning small amounts. Bartering income, basically the market value of any bartering activity should be reported as other income. Those are the kind of things that would appear in line 8. Line 9 would be the sum of lines 1C through 8. So you're totaling up your income from all your different farming activities and then putting it in line 9. And if at least 2/3 of that, your gross income is from farming, this is line 9, then you're considered for farming, for filing estimated tax purposes. Okay. What's not reported on a Schedule F? Sales of farm business property, because you're not in the business of selling tractors or selling equipment or selling high tunnels. Those get reported somewhere else. They get reported on 4797, the sale of business assets. Sale of breeding stock, dairy stock, draft livestock do not get reported on the Schedule F because they're considered capital assets. This is one of the biggest mistakes we see with CPAs and others who are unfamiliar with agriculture. They treat the sales of cull animals and dairy animals that are held for breeding purposes or dairy purposes as ordinary income on Schedule F, and it's not. It's capital sales of assets, and we'll talk about those briefly in a few moments. Farm loans is not income. Farm loans you use for something else. Transfer of personal farms into your farm business account is not income reported on the farm Schedule F. Expenses, pretty much a lot of these are self-explanatory. They're listed alphabetically. Some are going to pertain to your farm, some probably are not going to pertain to your farm. In some of the categories, you may have additional categories that you use that are summarized in one of the individual lines. Like, for instance, feed, you might have different types of feed, or supplies, you're going to have different categories of supplies which you bring together all in report as supplies under line 28. They're not going to be necessarily in the same order that you have in your records. Just keep that in mind. What you want to keep in mind is when you're looking at these categories, can you easily convert the information that's in your record keeping system to the categories that's required to report on Schedule F. Okay. So the first set of categories, I'm not going to talk about all of them, but I want to talk about a few of them. So the ones that are pretty obviously related to agriculture are the ones that are listed on this particular slide. So we're talking about chemicals, feed, fertilizer, limes, freight trucking, seeds and plant supplies, veterinary breeding and medicine. And so these are what we typically would consider crop and livestock production expenses that you would find in QuickBooks or some other sort of record keeping system. One of the things you want to keep in mind is if you're reporting again on a cash basis, you can include, feed that you purchased last year that you don't intend to use until the following year as an expense. Same thing with fertilizer and lime, same thing with chemicals, seeds and plants, and just general supplies. And there's some limits associated with prepaid farm supplies, how much you actually can deduct. in the year prior to using those supplies, but they're pretty liberal for the most part. In general, it can't be more than 50% of your other expenses, but there are some conditions under which you can actually exceed that. So the one thing about this particular kind of option you have in agriculture, when you prepay farm supplies, you shouldn't do it just for tax purposes. You should do it because it has a business purpose. You're getting a price that you can't get once the season starts, or you're buying your seed ahead of time because if you wait until January, February, you're not going to get the seed that you want. And that it doesn't really result in distortion of your income, a significant distortion of your income from farming. Those kind of issues, need to be considered when you're doing this prepaid purchases. All right, let's just take a break here. Any questions on prepaids or any of these kind of general farm expenses?
Mike, there was another question in the chat.
Okay.
Caroline is asking, if your LLC owns the farm and you work another part-time job, do you still calculate the 2/3 of gross income based on business income and personal income, or are they considered completely separate?
No, it's 2/3 of your income on your tax return. 2/3 of your gross income. So your tax return is going to combine personal and business share. So it's determined by household, if you will, income. So it's all taxable income. So it's also investment income. It's also retirement income. But remember, it's 2/3 of your gross income from farming. 2/3 of your gross income has to come from farming. So wages is considered a gross income, even though it's kind of a net. Well, I don't know if it's a net, but it's a gross income. All those items are considered gross income. So you take a look at your total gross income, and if 2/3 of it is from agriculture, is from that line 9, not the net income on the Schedule F, but on line 9, total sales, total income, then you can, you don't need to file a quarterly estimated payment of taxes for farming purposes. Okay.
Okay, great. And Jeff is asking, is freight and trucking different than simply calculating standard mileage if you're doing your own deliveries?
If you're doing your own deliveries, you're going to either do the standard mileage rate on your car or truck, or you're going to actually have the actual expenses associated with it. Yeah, freight and trucking is generally what you pay someone else to do the freight and trucking for you. That's generally what it's for on the Schedule F. It's not your cost of freight and trucking. We'll get to that in a moment. But it would be what you would pay somebody else to do to make that delivery for you. Okay, so I want to talk about one category expense is very difficult in taxes, and that's the depreciation expense. Basically, this is a way in which you recover the cost of property that you use in farming over that property's useful life for the most part. And so we're talking about, machinery. We're talking about fences, buildings. In order for something to be depreciable, it has to be owned, it has to be used in your business, it has to last more than 1 year, and it has to have returnable life. So in agriculture, the only thing that's not depreciable, that's property, is first the ordinary expenses you have that report on the Schedule F, but also the land. Land does not have a returnable life, therefore it's not a depreciable asset. But again, your buildings are, your machinery equipment are, your purchased breeding livestock are, your purchased dairy animals are depreciable assets. And the way you recover those costs is through the choices you have in depreciation. The choices we currently have in depreciation are shown on this particular slide. The first one is the bonus depreciation. It's really, right now, it's the current or default method that IRS assumes you're going to use if you don't choose or tell them that you're not going to use it. And what that does right now, we're under special rules which allow all of the asset to be deducted as an expense in the year that you purchase it. Okay? In order for that not to happen, you have to tell the IRS you don't want that to happen. And you actually have to attach an election to the tax return saying that you're electing not to choose bonus or special depreciation allowance. That will enable you to do what? That will enable you to take the deduction over several years, depending on the asset's life and what class it falls in, as opposed to deducting it all in the year that you purchase. Why would you do that? Well, you might need the expense to occur over several years, as opposed to all in the year that you purchased the asset. So I'll leave that be. And we're going to talk about an example in a moment. You probably already heard about Section 179 expense deduction. That's another method of rapid depreciation. And basically that says you can take up to, I believe for 2022, it's $1 million in capital asset purchases as depreciation in that year. Again, that's an option. That's not a default. The default is the bonus. Again, if you don't want the default, you have to tell IRS. The other two methods there, MACRS, GDS, is the regular depreciation method that we've been under rules for many years, and the assets get depreciated over their asset class life. I'll show you that in a moment. The ADS method stretches that life over a longer period of time. So this is a table in the IRS that is very useful if you're going to look at recovering those depreciable assets over their useful life as according to IRS asset class. And you can see under this that new farm machinery and equipment is 5-year life. Used is 7-year life. So those would be the years over which you would be able to recover that cost of that asset, as opposed to doing it all in the first year. Horses, well, let's not do that one. Fences are 7-year, and farm buildings, general farm buildings are 20. Horticultural structures, single purpose, basically greenhouses and high tunnels, are 10 years. If you wanted to use a slower method still, you can go to that ADS period. So for those greenhouse structures, it goes from 10 to 15 years. Again, what we're doing is slowing down the expense to match our income flow a little bit better. And for the farm equipment, the new farm equipment, it goes from 5 to 10 years. So there's something to consider when you're taking a look at this. These are called the property classes in that first column of numbers. And usually the property class is the period over which you are able to recover that asset if you choose not to recover it all in the first year. Take an example of a high tunnel. It's a single purpose horticultural structure, has a property class of 10 years. The total amount of the cost of that high tunnel is depreciated when it's placed in service, when it's ready to use. So if you're building it in 2022, but you still didn't use it and you're going to finish building it in 2023, you would hold all the expenses in 2022 in a capital account, add the additional cost of building that high tunnel in 2023, and start depreciating it in 2023 when you first have it available for use. That's kind of how the definition goes. On the other hand, if you buy a tractor or you buy a mower in December, you don't intend to use it till next year, but it's ready to use in December. And guess what? You can depreciate it because it's available and ready for use, even though most people wouldn't use a mower in December. So this particular asset, like many of the assets we have in farming, qualify for that special depreciation, that first year amount, or the section 179. By default, you're using special, and so all of that horticultural structure would be depreciated in 2023, the full value. You wouldn't have any left over for 24, 25, 26. If you do want something left over, you have to elect out of special depreciation by attaching a statement to your form saying you elect out for this property class. If I want to slow it down, I can use MACRS method to spread that cost over 10 years. If I want to do it even longer, I can use it to spread it out over 15 years. This stuff is complex. If you have depreciation and you're looking at significant assets, you need help from a professional advisor. And you really need to think about what those options mean. Okay, I'll leave that be. Depreciation is a difficult topic. Has a lot of different twists and turns to it. And you can go on for hours, but you need to just be aware of the fact that keep your mind open to working with someone else who knows a little bit more about this particular subject. Business expenses and personal costs. There's a bunch of categories here where you might have personal expenses as well as business expenses. It's important that you separate out the business part from the personal part, because only the business part goes on the Schedule F. And if you can't identify it specifically, then you're going to have to use a reasonable allocation. So for instance, like taxes, if you get a tax bill from the town for your real estate property taxes, you have to separate out what relates to farm property and what relates to your personal home. The home portion of taxes does not belong on the Schedule F, but the farm property property taxes paid does belong on the Schedule F. Same thing with insurance. So insurance, you can have business casualty, theft, and liability here. You can have accident insurance for your employees, but you cannot have health insurance that you paid for you and your family. Health insurance that you pay for you and your family, if you're the sole proprietor, actually becomes an adjustment to income and is placed elsewhere on your tax return. You can deduct it, but it doesn't get deducted on a Schedule F. Interest is the same issue with regards to if there's a mortgage, separating out the interest portion that belongs with the personal assets versus the interest portion that belongs with the farm property. Okay. There's some other expenses on that Schedule F that often need a little bit more clarification when we're dealing with folks. The first one is the car and truck expenses. So IRS allows you to deduct the actual cost associated with running your car or truck in your business or a standard mileage rate. The standard mileage rate in 2022 at the beginning of the year was 58.5 cents. At the end of the year, it was 62.5 cents. So we're currently under 62.5 cents per mile is the amount you can deduct if you choose to use a standard mileage rate as opposed to keeping track of your actual costs of running those car and trucks. Now, farmers have before I say that, you're supposed to keep a log of how many miles you travel and how many miles of those are related to business versus personal. And then basically you'll use the business miles with that standard rate to take the car and truck expense. Now, agriculture, if you use your car or truck substantially in your operation, I mean, on a day-to-day basis, regular activities and all that other kind of stuff, they'll allow you to use a 75% safe harbor rule, which says that you don't necessarily have to keep a log, but we recognize you're using that truck and car a lot, and so we'll allow you to take 75% of the miles of the total miles traveled and use that to determine your car and truck expense for the standard mileage rate or actual costs. Okay. Conservation expenses in farming, building a pond, terracing, anything that NRCS does under the conservation program, or I think even the Endangered Species Act, or anything a similar agency does, and you have a plan associated with it, are deductible to farmers. They are not deductible for non-farmers. And in order for you to do this deductible expense, that's all you have to do. You have is be involved with farming. You have to use the generic definition of farming. The expense is limited to 25% of your gross income, but it's still deductible. And if you can't deduct the full amount, it actually can be carried over to following years. If you hire someone to do pruning, if you hire someone to do some field work, and they're subcontractors, non-employees, they do it for other people, that kind of stuff, and their expense exceeds $600, then you have to file a Form 1099 NEC with the IRS, and you have to give the form to the individual as well. And these are basically reporting that they receive this, and it's only for people who are unincorporated and people who are not, or they're basically unincorporated, or if they're not affiliated with a nonprofit or with a government agency. Labor hired is line 22, basically report cash wages paid to employees, less than the employment credits. What's important is to make sure you differentiate between a subcontractor where you give them a 1099 and a person you employ, which you actually give, you have to actually keep track of hours as well as deductions for unemployment tax, as well as Social Security, and as well as withholding. You have to make deposits for folks on that basis. And a big thing that we often run into sometimes is people get their employee, they actually custom hire someone, but they actually, because the person is only working for them, doesn't do it for anybody else, uses the farmer's tools, is directed by the farmer as far as what to do and how to do it, they really become an employee and they're not a custom hire individual. So you got to be careful with this. If the person's an employee, do your background work, get the right paperwork completed, and make sure you withhold the appropriate taxes. Other expenses is a catch-all category in Schedule F. And the common things we see in that category is advertising, dues and subscriptions, legal fees, vendor fees, tools with a short life or a low price. Sometimes farm startup expenses might be in there that you're recovering over a period of time. Some pre-productive period expenses and business use at home would appear here. But those are the kinds of things we typically see in this other category. What's not reported as a farm expense on the Schedule F, your labor, that's not an expense. You're getting what's left over. Your owner's health and life insurance costs, those are personal. Principal payments on farm loans are not an expense. Owner's draws for family living or personal use are not an expense. And probably one of the more abused things that we see even in farms that have been people that have been farming for years is that market value of gifts and donations produced on a farm are not a business expense. You can't deduct the cost of raising those products as well as deduct the market value of those products on your tax return. You're only allowed to deduct the costs associated with producing those products that you have given away or donated to others. Okay. Total expenses, we total those up on line 33, we subtract it from line 9, and we end up with a net farm profit or loss on line 34. And in this case, the net profit or loss is $7,475. And for the most part, again, farms, because they're basically your amount of activity you have involved with the farm, you're pretty active and fully active in these operations, and you're pretty much putting property at risk of loss if you don't do well. And so for most guys, we're answering 36 with a check in block in part A. All the investment is at risk. I'm at risk of losing it. I'm using my property. I'm fully involved with this operation. So what that means is that $7,475 is profit that's going to be reported on Schedule 1 of Form 1040 and get added to your other sources of income. It's also going to be reported on Schedule SE, and it's going to be subject to self-employment tax. So one of the things you have to be careful with this is this line right here, that $7,475 is not only taxable from an income tax standpoint, but also taxable for SE, because that's your contribution from your self-employment activity to Social Security and Medicare. And so when people see the $7,475, they might have a 10% income tax on that, but they also have a 15.3% self-employment tax on much of it as well. So they become surprised with how much tax they actually owe. So one thing to be careful of.
Mike?
Yep.
We have about 6 minutes left.
Yep.
And there are a couple questions. Can I?
Yep.
Okay.
Go for it. I'm just trying to get my location here. There you go.
Okay, one of them is, if I receive an NRCS grant for a high tunnel,
Yep.
is the cost of the tunnel an expense or a capital asset to be depreciated?
It's a capital asset to be depreciated. And you can take the full amount under that additional first year depreciation. That's the only way I know how to expense a high tunnel. The problem you might have is that if you receive money for not only the construction of the high tunnel, but reimbursing you for your time and labor, you know, you can't put that into the cost of the high tunnel. That actually would reduce the cost of the high tunnel by that amount, because that actually is reportable income. And just report the full amount and deduct as much of the tunnel as you can without your labor reimbursement in there. Okay.
Okay. All right, Steve, let us know if that answered your question. And another question came in. What if your CPA has not been complying with these rules and they refer to separating out stuff for Schedule C and Schedule F?
Is your CPA willing to represent you if there's a question with the IRS and the preparation of tax returns, and what's their availability? Do you feel comfortable with the level of risk the CPA is taking? Are we talking about substantial, you know, risks here? I mean, big dollar amounts, or are we talking about small dollar amounts? And do you feel comfortable with that level of risk in that gray area? Because there's a number of gray areas here that can go either way. If you don't feel comfortable with the level of risk your CPA is taking and they're not willing to represent you, if it's a case of an audit, I would say you might want to look for another CPA.
Okay, great.
That's my general opinion.
Okay. I didn't know if you had any final things to talk about. There's about 3 minutes left.
Real quickly, can we scoot through this in 5 minutes, you think?
Let's do it.
All right. Yeah, so here's the information returns that you have to receive that are common in agriculture. Business owners are going to receive either a 1099 for services from others, or a 1099-G from government payments, or if you're part of a co-op, you might get a 1099-P ATR. You're going to need to file one if you pay somebody $600 or more for services or for rent, or if you paid some individual interest on as part of your farming business expense. You're not required to file these forms if you make these payments to corporations, government agencies, or tax-exempt organizations. All right, these are the examples of the forms. This is the form that you report business property on. It's a 4797. It determines how much gain or loss is taxable. One of the reasons why you want to make sure the information goes on this form is because any gains that are reported on this form, if they're long-term capital gains, they get a preferential tax rate, and all of the gains reported on this form are not subject to SE tax. Remember the Schedule F, the income is SE taxable as well as income taxable. Here, it's only taxed at your income level, and it may actually, in fact, have a preferential rate if it's been held for a period of time. In fact, you may have zero taxes on the gain, depending on your taxable income. Self-employment tax, this is where you have to put your self-employment earnings on a self-employment tax form, and you're required to file this form if your net earnings are $400 or more. If you have no net earnings or they're less than 400, you do not have to use this form, and you do not have to calculate SE tax. Estimated taxes, I will drop that one. One of the areas that Chris asked me to touch was just a little bit about farm records and income tax reporting. Make sure that you keep income categories separate for sales of market livestock, crops, and other items purchased for resale. And then that big category line 2, sales of all crops, livestock, and market grown, as well as agricultural program payments, patronage dividends, custom hire, and other income. On your expense side, a number of different programs have expense categories. Think about the expense categories you have to report in the Schedule F before you decide what expense categories you're going to keep. And don't forget to allocate shared expenses between business and personal. And you have to make sure you adjust your loan interest payments to make sure that only interest paid is there, not the principal. And there are some expenses, whether you're reporting on a farm base or Schedule A, Schedule C, that are not allowed to have prepaid amounts. And so you can't prepay interest, you cannot prepay insurance, and you cannot prepay property taxes. They have to apply to the year that you actually had the expense. We talked a little bit about subcontractor work versus hired employee wages. Make sure you meet the filing requirements of each. This is the other category you want to keep track of. Business transactions. Don't forget that you still need records on these. For the most part, these are items that last longer than a year and cost more than $2,500. These are the categories you want to make sure you keep track of and make sure that you have your activity in terms of purchases and sales and how the depreciation occurred over the useful life of the asset. Choosing a tax preparer, I'm going to give this so that Chris has this so you guys can pick it up. This is where you can actually check on the preparer's qualifications. I say if you're dealing with a CPA or anybody else, make sure they know at least family businesses, if not farms. Make sure you know their fees, make sure they're available, ask how they handle these questionable areas, and if you're comfortable with the way they're handling these questionable areas, and find out their willingness or limits on audit representation. Lastly, always give your CPA or tax preparer all the information you have. Review the forms before signing. Never sign a blank form, and make sure your preparer signs and includes their taxpayer information and number. There's a number that they have as tax preparers. Oops. Yeah, I skipped that one real quick. There we go. I'll leave on this. These are some sites that I think you might find useful. A lot of people don't realize that IRS has specific sites associated with small businesses and agriculture. That's what the second 2 sites are. This one, if you go into small business, self-employed, and you put Tax Ag Center, you'll actually come up with a number of tax related information pertinent to agriculture. This particular site right here, Tax Professionals, choosing a tax professional, you actually can check on the background of the people that are preparing your taxes, or look for people in your area that actually are CPAs or enrolled agents or attorneys that do taxes. These are the other sites that we often use to gather information, and the program that we're offering here is basically governed by Ag AFTA. Here is my email. If you want to get in touch with me, ask me a question, or have a question about something I might have said during this presentation. That's it, Chris. I'm sorry it was such a rush session. Sometimes they go easier, but I hope you guys got something out of it.
Well, I'm just so glad that there were so many questions, people willing to ask questions. There are a couple more questions in the chat, but I think that I will have Mike answer them in the follow-up email that we send out. So we'll be sending out his presentation, a link to this recording, and a few other resources. So please check your emails in the next couple days. And thank you so much for coming. And thank you so much, Mike. This was incredible.
Well,
Thank you.
Thank you. I hope it wasn't too confusing.